Two investors buy the same fund on the same day with the same amount of money. 1 decade later, one of them has built something substantial. The other has roughly what they started with, maybe less. Same fund, same starting amount, different outcome. How is that possible? The answer is almost never what they bought. It is everything they did afterward. Somewhere in the space between the first deposit and the last account statement, behavior becomes the variable that explains the gap. Not the market. Not the fund, the investor. The decisions made on a Tuesday afternoon when the numbers looked bad. The adjustments that felt rational at the time. The moments when watching became deciding and deciding became undoing. That is what this is actually about. For most of its history, the investing industry has sold one premise, that choosing the right asset is the key to building wealth. Pick the right stock, the right fund, the right sector at the right moment, and the math works in your favor. Get the selection wrong and no amount of patience will compensate. That idea is the foundation behind financial media, premium research services, manager track records, and most of what passes for investing advice. But researchers who study actual investor accounts, not hypothetical scenarios or backtested models, but real people with real money tracked over real decades, keep arriving at the same uncomfortable finding. There is a persistent, measurable gap between how an investment performs and how the people invested in it perform. That gap is wide, it is consistent across market cycles, and it is driven almost entirely by what investors do in the moments between statements. The selection is almost never the problem, the response to the selection is. This pattern has been documented for decades. Peter Lynch managed one of the most successful funds of the 1980s, generating extraordinary returns over his tenure. What made this uncomfortable was not the performance itself, it was what the investors in that fund actually experienced. Many of them entered after strong years when the evidence for buying felt overwhelming and obvious. Many of them exited after downturns, when the case for leaving felt equally obvious and well supported. They responded to information the way most educated people respond to information, by updating their position when conditions changed, and it cost them. Lynch spoke about this directly. The average investor in his fund did not have a good experience because they could not stop reacting to it. The fund performed, the investor behavior did not. The investment worked exactly as designed. The investor's response to that investment did not. The lesson was available in the 1980s. It is still mostly unlearned. Here is what is happening at the level of incentive and decision. Every time a market declines significantly, the brain runs a calculation it has been running for most of human history. The pain of the current loss feels immediate and certain. The potential gain from staying invested feels abstract and distant. Cutting losses is the correct response to almost everything in ordinary life. A failing project gets cancelled, resources stop flowing toward things that are not working, and the person who recognized the problem early is usually right to act. Investing is the rare domain where this logic reverses. Markets do not reward the investor who responds appropriately to bad news. They reward the investor who stops responding altogether. The mechanism is compounding, the mathematical process of returns building on prior returns year after year, and compounding is strictly time-dependent. Every exit and re-entry interrupts the sequence. The sequence is exactly what accumulates into wealth over long horizons. Disrupting it once at the wrong moment can cost more than a decade of contributions. The problem deepens because the most dangerous moments to make a decision are also the moments when making one feels most justified. When a market falls sharply, coverage is saturated with credible analysis explaining why this time is structurally different from prior cycles. Analysts with strong track records identify specific mechanisms that could extend the decline. The case for exiting is rational, evidence-based, and emotionally coherent. The case for holding is essentially, trust a thesis you developed in calmer conditions even though the conditions have now changed significantly. Most investors who exit during a major downturn do not re-enter at the bottom. They wait for clarity, some signal that conditions have genuinely stabilized. That clarity typically arrives well after the recovery has begun. So the exit happens on the way down and the re-entry happens on the way back up. The sequence breaks twice, both breaks carry a cost. And the investor who made both moves likely felt they were being thoughtful and appropriately responsive, not making a mistake but managing risk. There is a real counterargument worth examining carefully. Not every decision to sell is behavioral error. A company's underlying business can deteriorate in ways that genuinely matter for long-term value. An investment thesis can be wrong at the foundation, not just temporarily out of favor. A life event can create legitimate liquidity needs that override any long-term plan. In each of these cases, acting is the right call. Holding through inertia when the situation has fundamentally changed is its own mistake. The trap is not selling. The trap is confidence, the belief that you are the kind of investor who acts for sound fundamental reasons, rather than the kind who reacts because prices moved. Research on actual investor decision-making consistently finds a gap between how investors explain their decisions and what actually drove them. Most people believe they are in the first category. The timing of their actual trades tends to tell a different story. The honest question is not whether you are capable of good judgment under pressure. It is whether you can design a process that does not constantly require it. Consider two people who begin investing in a broad, diversified fund in their early 30s. Identical starting conditions, same fund, same monthly contribution amount, same first deposit. One builds a simple automated structure. Contributions transfer on a fixed schedule, the portfolio is rebalanced once a year at a fixed date, and the account is reviewed no more than quarterly. During the first major market decline they experience, they make no changes to the structure. During the second they make no changes. The process runs as designed. The other investor is engaged and thoughtful. They read regularly, follow market commentary, and adjust their position based on current performance signals. They exit once during a significant downturn and re-enter several months later after conditions appear to stabilize. They believe they are being appropriately active and responsible with their money. After 2 decades, the difference in outcomes between these two accounts is not primarily explained by the fund's performance during that period. It is explained by the number of times one investor disrupted the compounding sequence and the other did not. The engaged investor cost themselves their own returns. So the practical takeaway is this: the most valuable investing habit is not knowing what to buy. It is building a process that minimizes how often you need to decide anything at all. Automation does more work than insight in most investors' actual experience. Consistency does more work than cleverness. The investor who sets up automatic contributions, holds through volatility, and intervenes only when something about the underlying situation has genuinely and fundamentally changed is not being passive or disengaged. They are executing the strategy precisely as it was designed, and the design is the point. The anxiety that signals you should be doing more, checking more, adjusting more, responding to what just happened in the market, that anxiety is the thing to manage, not the market. The market will do what it does. The question is what you do when it does it and whether your answer costs you or compounds for you. 2 investors, same fund, same starting day. One ends up with significantly more than the other. The investment did not create that gap. The behavior did. There is something genuinely uncomfortable in that conclusion. It means the highest leverage skill in investing for most people in most situations is not research or analysis or identifying the right opportunity before others do. It is the ability to do less when every instinct says to do more, to hold the original thesis when the environment argues against it, to let the sequence run when interrupting it feels like the responsible, informed choice. Your first investment probably was not perfect. Your second might not be either. But the investor who builds wealth over a long horizon is not the one who chose best at the beginning. It is the one who stayed.